someone who looks at markets and macros very closely. Sorry. I'm joined by Ketaki Sharma, who's joining us from Algorithm Research. She looks at the world of investing through the lens of macros. Ketaki, welcome to ET Now and Newsroom. Thanks very much for joining us.
Thank you so
First,
much.
let's start by getting your thoughts on the importance. Great. Importance of the US CPI this time, and what is the probability would you assign that there would be a sequential dip?
Sure, Ajay. So, first and foremost, since the pandemic, a lot has changed in terms of how we work, where we work from, and therefore, the data collection is something that we need to prioritize. The markets tend to react positively or negatively, or tend to really react to a macro release. But since the pandemic, we've noticed that there have been upward revisions in almost, in like two-thirds of macro data released globally. And it is something that is a global trend. We've seen German macroeconomic data being released 2 out of 3 times. Similarly, US macro data being revised up several times. So what we are noticing now is that the initial reaction to data, especially macro data, is what gets recorded and what impacts confidence. Whereas the final revisions that happen that should actually impact confidence, they tend to go unnoticed. And this is primarily because the way we work has changed, but the way we collect data is still adapting. So while we focus on data releases, new data releases, I think it would be imperative to watch out for revisions in data and adjust our expectations accordingly.
Right. Ketaki, what are your thoughts when you look at this high frequency data as well as overall the data which has been released by RBI or various regulators or agencies on the trajectory? Do you see the inflation trend lower sequentially from here on in a meaningful manner, or do you see a off the cliff reading and then it will stay back? And because one sense is that we may have said goodbye to the kind of inflation indicators we used to seeing. So inflation may not go back to 2% odd in US or sub 5% in India as well. The new normal could be much elevated, and we'll have to live with that.
Yeah, I agree with you, Ajay, that the new normal will be elevated. And this is a result of many things. Of course, global commodity prices are going to play a big role into this. But also the fact that we've had this huge, quantitative easing that has happened. And of course, there's winding down. We have been winding it down, but the implications there's a lag, right? So we have been tightening rates, but we will see the impact of these only 3 to 4 months from now, and in a gradual manner. So there are two parts to it. One, of course, is the commodity price related and induced inflation. That, of course, will likely hold up this year as well, the entire year. And the other part, of course, is when you are actually targeting demand through monetary tightening. So, of course, we are going to see a shrinking of domestic demand here as well as globally. But as far as crude oil prices are concerned, we expect them to remain at elevated levels whole of this year for the entire year, and that is going to impact inflation, consumer price inflation through the various categories, not just through the fuel category with transportation that will feed into food, because food gets sent from rural areas to urban areas. So we're not expecting this to go away anytime soon. Of course, next year onwards, when the base effect kicks in, that's when we are likely to see a better reading of the previous compared to the previous year.
Ketaki, there is also a sense that the reason we've had this very spectacular 15% rally in global equities along with Indian equities recently is because the street somewhere has started to factoring in ahead in the cycle events which may unfold. And the next 6 to 8 months far out, the sense is that regulators, because of the growth slowdown, may be forced to tone down their hawkishness. Some are even saying that it may go to the extent of a fresh QE. What are your thoughts on this hypothesis?
Well, I think it might be a bit too early to talk about QE because from what we are seeing right now is actually higher demand as well as higher input prices. So at the moment, the focus would be to combat to look at how we can minimize the effect of input prices on overall disposable income so that growth GDP growth, domestic demand destruction doesn't happen. And to that effect, we see that the recent developments around work from home have been quite positive. So imagine to be in the same scenario wherein you have such high crude oil prices, and we were not witnessing something like work from home. The fuel budget would be much higher, your transportation budget would be much higher, and that would eat into your disposable income. Now with the current situation, the current work patterns, what we are seeing is that this is very supportive of disposable incomes. So domestic disposable incomes are going to benefit from the new patterns of work. And for now, I don't foresee anything like a fresh round of QE. I think it'll be a bit too early to talk about it.
Okay, fair point. But markets are a forward-looking animal, and they do start factoring in a lot of stuff which is ahead in the future, just like they did. I may just remind you that the peak of pessimism in COVID was the exact bottom of global equities market. And following weeks and days, we saw a very sharp rally. But anyways, just a quick word on the quality of growth you are looking at in India. There is a sense that India may be relatively much more insulated by growth shocks across the world because of our wonderful demographics, etc. How much would you agree to that? And what are the monitorables you would keep your eyes on as far as monitoring the quality of growth here in India?
So absolutely agree with you there, Ajay, that I think India would do better compared to the other emerging markets for sure. Already we can see that in the exchange rate when other emerging markets have seen like a complete you know devaluation, depreciation in their exchange rates. India has fared very well, and we expect this trend to sort of continue because India has, as you said, a fantastic demographics, domestic market that's able to support this kind of growth, and I think markets are taking that into account. Um, so we've done these we've analyzed internet searches that are made in India over the past year or so, and we've noticed that there has been a shift in preferences, even so shift in preferences for locally produced good, including like cars, such as cars produced by Mahindra and Tata. So there is definitely, that thing that kind of supports the economy, the increased localization. So in the past couple of years, particularly since COVID, we have seen that there has been a trend towards localizations or de-globalization. And in India, we've seen that happening through the internet searches as well. And of course, the market share data is also pointing towards the same direction. So I think there are many positives. Firstly, of course, there is the demographics. There's the local population that supports that GDP growth. Secondly, the fact that again, the fuel prices are not making the dent that it could have made on disposable incomes. So that helps with investments, with savings. Thirdly, you see there's the positive development in terms of work from home policies. So that brings in more people into the workforce, including a lot of women who were marginalized, with the expectation of working from offices and doing the long hours. So now when they can work from home, they can do the long hours, and but at their own terms. So there's a lot of positives going on, and there's the other development wherein we are seeing a lot of services that are being shifted from across the globe to India. So there is a definite move towards outsourcing, and this time it's not just the big companies that are outsourcing some of their jobs to India, but I have seen households moving their, say, tuitions to India, moving their kids' online chess classes to India. So there is this job creation, especially the work from home job creation, online job creation, that is supporting GDP growth, that's supporting the currency, and that is buoying India's growth story.
So one quick last word. How many basis point further rate hike do you see before RBI goes for a pause? 100?
Okay, so I think I have a contra call here. I think the RBI, at least for the next couple of months, should have this wait and watch policy rather than go for 100 or 50 bip rate hike, and that's largely because to see any kind of impact of the recent hikes on wider macro data, you would have to give it time. It comes with a lag. And I think RBI is cognizant of the fact that too much too soon would actually kill growth that is a positive for India, and without really addressing the inflation issue, because most of it is due to the commodity prices. So of course there is core inflation that has gone up, and that is obviously at uncomfortable levels. But we've seen RBI taking enough actions recently, and they have been in sync with what is happening globally. So my call is that there won't be anything for the next couple of months.
All right, Ketki, that's a lovely contra call you have out there, a pause for the time being. Let's see, that'll be good news for the street though. Good interacting, thanks very much for your time. We'll chat up with you soon again. But time for a short break. On the other